Beijing sending a warning to Hong Kong that it plans to intervene in the situation with mass protests if they deteriorate. Markets and investors, of course, watching all of this closely. And here to discuss it right now is Daniel Rosen, Rhodium Group founding partner. Also, Patrick Chovanec, Silvercrest Asset Management chief strategist. Patrick, I'm going to go to you first on this. There's sort of a chicken and egg situation here, which is how bad does it get before China intervenes? And if they do, what does that mean, therefore, for the markets?
Yeah, it's something that we're watching because mainly because of the threat of capital flight. You know, people keep their money in Hong Kong because it's got rule of law, because to some degree they're immune from the whims of Beijing, or at least insulated from them. And, you know, Singapore right now is kind of quietly courting people to say maybe Singapore is a safer place to keep your money. And they're, unlike China, unlike the mainland, there's no barriers to capital leaving. All you have to do is, you know, click the enter on your computer and the money goes.
So politically, though, and maybe you can speak to this, Daniel, both the economics of it and the politics of it. First of all, if China does jump into this situation, how quickly does money move, and therefore what happens?
I think a lot of money is probably moved around already. And we got the trade numbers this morning. We're seeing a lot of regional rebalancing and where exports are going, where they're not going, where imports are coming from, where they're not coming from. So both in terms of trade and finance money, we see people moving all summer here. They've been doing it in anticipation of what's playing out sort of in slow motion in front of us. I want to point out one thing about Hong Kong that most folks haven't looked at yet. Its relationship to the entire South China economy, the Pearl River Delta ecosystem, as we have talked about it for decades, is inextricably connected to Hong Kong's role as an entrepot for that part of China. And if Hong Kong, needs to go to the intensive care unit, then that puts the PRD, as we say, the Pearl River Delta, out of business a little bit as well. So that's something to think about.
The longer this unrest goes on in Hong Kong, does that make China more willing to reach a deal with the United States or less?
It's really on different channels, right? Mm-hmm. This is now in the category of deeply, profoundly political phenomena for China. And from Beijing's perspective, the kind of discord that we're seeing on the streets of Hong Kong is unacceptable socially, politically, culturally. And that's understandable. Business people worldwide sort of try to move away from this sort of thing happening in the streets. So it's going to be treated differently than the trade dynamic.
Anthony, White House question.
Yeah.
And this may sound perverse. Do you think that the White House wants these protests to continue?
I don't.
You don't?
No, I don't.
You don't think that the protests give them leverage in this whole larger conversation?
Don't think so. I think the protests, frankly, are distracting from the macro issue. At the end of the day, notice the administration's position on these protests. They're not encouraging the protests. They don't want a Chinese spring. What they want is a good bilateral relationship with the Chinese and more trade symmetry. So I think the protests are a distraction to a much bigger economic situation.
China's leaders right now, though, are having their big powwow, their leadership summit. And, the sense is that they're really in a defensive mode, that they're kind of on lockdown. And I think that does spread across multiple issues. They feel on the defensive. It makes it harder for them to take risks, whether it's with economic reform, whether it's with a trade deal with the United States that involves some concessions.
So this will harden them in terms, make them less willing to compromise?
Yeah, all the things I hear out of China are that they're kind of hunkering down. You can blame the trade strategy, you can blame what's going on in Hong Kong, but there is not an appetite for either political or economic risk right now in China.
Quick question, I'm just curious. Has the Western media over-exaggerated the economic colossus of China? Is it way more hollowed out on the inside than people think? And then the second question is, can they sustain themselves if they go full-blown insularity and they make a 10-year bet to disengage from the United States and try to engage the rest of the world?
So China's economy slowing, and it would be slowing with or without the trade war, the trade tensions. They've got a lot of issues with overinvestment, excessive dependence on credit, and mounting bad debt. They've got their hands full trying to deal with that, and the trade war doesn't help. But the question is, what direction does trade pressure push them? Does it push them towards the kind of reforms that we want to see and open up to address those issues, or does it push them back into the bunker? And my sense is that it's made them much more defensive.
You had a thought on that? And by the way, the media played second fiddle to the financial community worldwide in terms of pumping up the China that we thought we knew. But going forward, tremendous amount of Chinese economic potential for decades to come. But it's all contingent on hard reform work that has to happen back home in China.
Tom Farley, exchange question for you. So many companies wanted to go public in Hong Kong for so long. Is that now off the table for, I mean, not just now, but I'm saying, is that off the table for the next 24, 36 months if you were a CEO, irrespective of what, even if this all gets solved, do you say to yourself, actually, I'm out?
Not yet, but this entire segment, that's been what's going through my mind. The H shares were attractive because of rule of law, because of the fact that if I put capital in Hong Kong, I knew that that was protected, free of interference from Beijing. That will change very, very quickly. You'll see more international IPOs. However, I want to add one other element. If this trade war intensifies, you could imagine one of the weapons of war would be saying Chinese companies cannot list in the U.S., which would be a terrible thing for our capital markets. So there are unintended consequences here. It's a box I don't want to open up. But the short answer is it could impact Hong Kong.
And another market-related issue that did get opened up this past week is the prospect of Chinese devaluation or depreciation of China's currency. I get a sense right now that the White House is kind of doing high fives this morning and saying, well, they put it back below 7, so mission accomplished. We really ward them off. I think that would be a potentially tragic misreading of this situation. China. There are a lot of costs and risks associated with China allowing its currency to weaken, and it's been reluctant to do that. But it did allow it to weaken by 5% last year in order to blunt the impact of tariffs. And there's a strong temptation for them to do the same if they face even higher tariffs.
Do you think there were high fives at the White House?
I don't. I think there's a lot of uncertainty in the White House. Honestly, you can't figure out what's going to go on. But I will tell you this, culturally, and I'm not a China expert, but I think losing face for Chinese leadership is a big deal. And the White House should really figure out a way, if they want to resolve this trade issue, to come up with a way for the Chinese not to lose face. Otherwise, it's going to be way longer, way more protracted. And if you run the risk of putting the United States into recession, your 2020 election prospects are dimmer.
Daniel, what do you think the game plan of the PBOC is? I mean, the yuan is already down 3.7% in the past 3 months. And you made the point in your note that it looked like the PBOC was trying to distance itself from other central banks in saying that it will not ease further, which is what a lot of people had expected, that there would still be a rate cut on the horizon for that economy.
Extraordinary thing this week on this topic. Rhodium put a note out on it. What was most fascinating was not the move of the value of the renminbi, but the argumentation that the People's Bank put out around it, saying that essentially this is good for global investment. Global capital should come into China. It showed their weak spot, that while they can say they don't care that much about a deal with the U.S. if the Trump White House doesn't want to play right,
really do.
They can't live without global capital.